Question 1. Which of the following activities primarily takes place in the secondary market? A. Initial public offerings, IPOs. B. Trading of previously issued securities between investors. C. Issuance of new bonds by a corporation to raise capital. D. Underwriting of a new stock offering by an investment bank. Answer: B. Trading of previously issued securities between investors. The secondary market is where investors buy and sell securities that have already been issued. This trading occurs between investors, facilitated by exchanges or over-the-counter markets. In contrast, the primary market is where new securities are first issued to raise capital for companies or governments through activities like IPOs and new bond offerings. Understanding this distinction is crucial for comprehending how capital flows through financial markets and how securities are valued after their initial sale. Question 2. A customer who wants to ensure they can buy or sell a stock at a specific price or better should use which of the following order types? A. Market order. B. Limit order. C. Stop order. D. Discretionary order. Answer: B. Limit order. A limit order allows an investor to specify the maximum price they are willing to pay when buying or the minimum price they are willing to accept when selling a security. Unlike a market order, which is executed immediately at the best available price, a limit order guarantees the price but not necessarily the execution. If the market price does not reach the specified limit, the order may not be filled. This order type is valuable for investors seeking price control, especially in volatile markets. Question 3. Which of the following is true regarding common stock? A. Common stockholders receive fixed dividend payments. B. Common stockholders have priority over bondholders in case of bankruptcy. C. Common stockholders typically have voting rights. D. Common stock offers a guaranteed rate of return. Answer: C. Common stockholders typically have voting rights. Common stockholders are the true owners of a corporation and typically have voting rights, which allow them to elect the board of directors and influence corporate policy. Unlike preferred stockholders, their dividends are not fixed and are declared by the board of directors, meaning they are not guaranteed. In the event of bankruptcy, common stockholders are last in line for asset distribution, behind bondholders and preferred stockholders. This ownership stake provides potential for capital appreciation but also carries the most risk. Question 4. An investor owns a bond with a 6% coupon rate, currently trading at a premium. Which of the following statements is most likely true regarding its yield to maturity, YTM? A. The YTM is equal to the coupon rate. B. The YTM is higher than the coupon rate. C. The YTM is lower than the coupon rate. D. The YTM cannot be determined without knowing the par value. Answer: C. The YTM is lower than the coupon rate. When a bond trades at a premium, its market price is above its par value. This means an investor buying the bond will receive less than they paid at maturity, the par value. Consequently, the bond's yield to maturity, YTM, which factors in the capital loss if held to maturity, will be lower than its coupon rate. Conversely, if a bond trades at a discount, its YTM would be higher than the coupon rate. Understanding this relationship is critical for assessing the true return of a bond investment. Question 5. Which type of investment company issues a fixed number of shares that trade on exchanges and are not redeemed by the issuer? A. Open-end mutual fund. B. Unit investment trust, UIT. C. Variable annuity. D. Closed-end fund. Answer: D. Closed-end fund. A closed-end fund issues a fixed number of shares that are traded on stock exchanges, similar to individual stocks. Unlike open-end mutual funds, these shares are not redeemable by the fund itself, and their market price is determined by supply and demand, often differing from their net asset value, NAV. This structure allows for active management and potential for trading at a premium or discount to NAV. Understanding the distinction between open-end and closed-end funds is fundamental when evaluating investment company options. Question 6. Which of the following regulatory bodies is responsible for enforcing federal securities laws and regulating the securities industry? A. FINRA, Financial Industry Regulatory Authority. B. MSRB, Municipal Securities Rulemaking Board. C. SEC, Securities and Exchange Commission. D. FRB, Federal Reserve Board. Answer: C. SEC, Securities and Exchange Commission. The Securities and Exchange Commission, SEC, is the primary federal regulatory agency responsible for overseeing the securities industry, protecting investors, and maintaining fair and orderly markets. It enforces federal securities laws such as the Securities Act of 1933 and the Securities Exchange Act of 1934. While FINRA, MSRB, and FRB play significant roles, the SEC holds ultimate authority in federal securities regulation. Understanding the SEC's pervasive influence is essential for anyone operating within the financial services industry. Question 7. A customer opens a joint account with their spouse. Upon the death of one spouse, the surviving spouse automatically becomes the sole owner of the account's assets. This is characteristic of which type of joint account? A. Tenants in common, TIC. B. Joint tenancy with right of survivorship, STROS. C. Community property. D. Tenancy by the entirety. Answer: B. Joint tenancy with right of survivorship, STROS. Joint tenancy with right of survivorship, STROS, is a common form of joint account where, upon the death of one account holder, their share of the assets automatically passes to the surviving account holder, S, bypassing probate. This differs from tenants in common, TIC, where each owner's share is typically passed on to their estate upon death, rather than automatically to the surviving co-owner. STROS is often chosen for its simplicity in asset transfer and estate planning. Understanding these distinctions is crucial for proper account registration and succession planning. Question 8. Which of the following actions by an associated person would be considered a prohibited practice related to insider trading? A. Executing trades based on publicly available research reports. B. Disclosing material, non-public information to a client who then trades on it. C. Trading based on an educated guess about a company's future earnings. D. Sharing aggregated, anonymized market data with clients. Answer: B. Disclosing material, non-public information to a client who then trades on it. Insider trading involves buying or selling a security, in breach of a fiduciary duty or other relationship of trust and confidence, while in possession of material, non-public information about the security. Disclosing such information to a client, known as tipping, is also a violation, even if the tipper does not trade themselves. This practice undermines market fairness and is strictly prohibited by securities laws to ensure all investors have equal access to information. Associated persons must always prioritize ethical conduct and regulatory compliance to avoid severe penalties. Question 9. An investment bank acting as a firm commitment underwriter for a new stock issuance assumes which of the following risks? A. The risk that investors will not buy the shares. B. The risk that the issuer will default on its payments. C. The risk that the SEC will reject the registration statement. D. The risk that the underwriter cannot find enough syndicate members. Answer: A. The risk that investors will not buy the shares. In a firm commitment underwriting, the investment bank agrees to purchase the entire issue from the issuer and then resells it to the public. This means the underwriter takes on the financial risk of selling the securities. If they cannot sell all the shares to investors, they are obligated to purchase the unsold portion for their own account. This contrasts with a best efforts underwriting, where the underwriter only agrees to sell what they can. Understanding these different underwriting commitments is vital for assessing the risk assumed by the investment bank. Question 10. What is the primary characteristic of a general obligation, GO, bond? A. It is backed by a specific revenue stream from a project. B. It is considered a moral obligation bond. C. It is secured by the full faith and credit of the issuing municipality, backed by its taxing power. D. It is primarily used to finance industrial development projects. Answer, C. It is secured by the full faith and credit of the issuing municipality, backed by its taxing power. General obligation, GO, bonds are municipal bonds backed by the full faith and credit of the issuing municipality, meaning they are supported by the issuer's general taxing power. This typically includes property taxes for local governments or income/sales taxes for state governments. Because of this broad backing, GO bonds are generally considered less risky than revenue bonds, which are secured only by the revenues generated from a specific project. Understanding this fundamental difference is key to evaluating municipal bond credit quality. Question 11. Which of the following is true regarding a Series 7 registered representative? A. They can only sell mutual funds and variable annuities. B. They are qualified to supervise other registered representatives. C. They can buy and sell a broad range of securities, including stocks, bonds, options, and investment company products. D. They are primarily involved in the municipal securities market. Answer, C. They can buy and sell a broad range of securities, including stocks, bonds, options, and investment company products. A Series 7 registered representative, also known as a general securities representative, is qualified to buy and sell a broad range of securities products. This includes equities, corporate and municipal bonds, options, investment company products like mutual funds, and more. This license is often considered the foundation for many roles in the securities industry due to its comprehensive scope. It does not, however, qualify an individual for supervisory roles, which require licenses like Series 9/10 or 24, or exclusively for municipal securities, which would involve Series 52. Mastering the Series 7 allows for extensive client interaction across diverse product offerings. Question 12. When a company repurchases its own shares in the open market, these shares become A. Outstanding shares. B. Issued shares. C. Treasury stock. D. Authorized shares. Answer, C. Treasury stock. When a company buys back its own outstanding shares, these shares are no longer considered outstanding for dividend and voting purposes and become known as treasury stock. Treasury stock can be held by the company indefinitely, reissued at a later date, or retired. Companies often repurchase shares to reduce the number of outstanding shares, which can increase earnings per share or to prevent a hostile takeover. Understanding treasury stock is important for analyzing a company's capital structure and shareholder value initiatives. Question 13. Which of the following risks can be mitigated through diversification? A. Systematic risk. B. Inflation risk. C. Interest rate risk. D. Non-systematic risk. Answer, D. Non-systematic risk. Non-systematic risk, also known as specific or business risk, is the risk associated with a particular company or industry. This type of risk can be significantly reduced or virtually eliminated through diversification across different companies, industries, and asset classes. In contrast, systematic risk, or market risk, affects all investments and cannot be diversified away, as it stems from broad market or economic factors. Understanding the difference between these risk types is fundamental to constructing a well-balanced and resilient investment portfolio. Question 14. A fully disclosed broker-dealer introduces its customer accounts to a carrying firm. Which entity is responsible for maintaining custody of customer assets? A. The fully disclosed broker-dealer. B. The carrying firm. C. Both firms equally share responsibility. D. The customer's investment advisor. Answer, B. The carrying firm. In a fully disclosed arrangement, the introducing broker-dealer introduces its customer accounts to a carrying firm. The carrying firm, also known as the clearing firm, is responsible for processing trades, maintaining custody of customer cash and securities, and handling back-office operations like statements and confirmations. The introducing broker-dealer focuses on client relationships and sales. Understanding this division of labor is crucial for knowing where customer assets are held and which entity handles administrative tasks, particularly in the event of any operational issues. Question 15. Which of the following is an example of a capital market instrument? A. Treasury bills. B. Commercial paper. C. Common stock. D. Repurchase agreements. Answer, C. Common stock. Capital market instruments are used for long-term financing, typically with maturities greater than 1 year. Common stock is a prime example, representing ownership in a company and providing long-term capital to the issuer. In contrast, treasury bills, commercial paper, and repurchase agreements are money market instruments, characterized by short-term maturities, generally less than 1 year, and high liquidity. Differentiating between money market and capital market instruments is fundamental to understanding their respective roles in financing and investment strategies. Question 16. Which document must be provided to a customer at or before the time of account opening for a margin account? A. Prospectus. B. Options Disclosure Document, OD. C. Margin Disclosure Statement. D. Form U4. Answer, C. Margin Disclosure Statement. For a margin account, FINRA rules require that a margin disclosure statement be provided to customers at or before the time of account opening, and annually thereafter. This statement explains the risks associated with margin trading, such as the potential for losses exceeding the initial deposit and the firm's right to sell securities without prior notice. While other documents like a prospectus or ODD are crucial for specific investments, the margin disclosure statement is mandatory specifically for margin accounts. Providing this disclosure ensures customers are fully aware of the heightened risks involved with borrowing to invest. Question 17. Which of the following investment risks is associated with the possibility that an issuer may fail to make timely payments of principal and interest on a debt security? A. Market risk. B. Inflation risk. C. Credit risk. D. Liquidity risk. Answer, C. Credit risk. Credit risk, also known as default risk, is the risk that an issuer of a bond or other debt security will be unable to make its promised interest payments or repay the principal amount at maturity. This risk is a primary concern for fixed-income investors. Unlike systematic risk, which affects the entire market, credit risk is specific to the financial health of the issuer. Understanding and evaluating credit risk is essential for bond investors to assess the likelihood of receiving their expected returns. Question 18. Under FINRA rules, a registered representative must complete regulatory element training how often after their second registration anniversary? A. Annually. B. Every 5 years. C. Every 3 years. D. Only upon initial registration. Answer, C. Every 3 years. FINRA's Continuing Education, CE, requirements mandate that registered representatives complete the regulatory element training within 120 days of their second registration anniversary and every 3 years thereafter for as long as they remain registered. This training is designed to keep reps updated on industry rules and regulations. Question 19. Which of the following is true regarding a prospectus? A. It must be provided to investors only for municipal bonds. B. It is an abbreviated document used for marketing purposes only. C. It provides full and fair disclosure of all material information about a new issue of securities. D. It is required for all secondary market transactions. Answer, C. It provides full and fair disclosure of all material information about a new issue of securities. A prospectus is a legal document that provides full and fair disclosure of all material information about a new issue of securities to potential investors. This information includes the company's financials, business operations, risks, and management. It is required for most new offerings under the Securities Act of 1933, ensuring investors have the necessary information to make informed decisions. A prospectus is not required for secondary market transactions, and its primary purpose is regulatory disclosure, not just marketing. Understanding its role is fundamental to investor protection in primary market offerings. Question 20. Which of the following describes the bid price in a stock quote? A. The highest price a buyer is willing to pay for the stock. B. The lowest price a seller is willing to accept for the stock. C. The highest price a broker-dealer is willing to sell a security. D. The price at which a trade was last executed. Answer. A. The highest price a buyer is willing to pay for the stock. In a stock quote, the bid price represents the highest price a buyer, typically a broker-dealer on behalf of a customer or for their own account, is currently willing to pay for a security. Conversely, the ask or offer price is the lowest price a seller is willing to accept. The difference between the bid and ask is the spread. Understanding these terms is fundamental to interpreting market quotes and executing trades, as it indicates the liquidity and current supply and demand for a security. Question 21. What is the primary purpose of the Customer Identification Program, CIP, under the USA Patriot Act? A. To ensure customers meet suitability standards for investments. B. To detect and deter money laundering and terrorist financing. C. To verify the customer's eligibility for specific tax-advantaged accounts. D. To ensure that all customer communications are approved by a principal. Answer, B. To detect and deter money laundering and terrorist financing. The Customer Identification Program, CIP, is a critical component of anti-money laundering, AML, regulations under the USA Patriot Act. Its primary purpose is to help financial institutions verify the identity of their customers to detect and deter money laundering and terrorist financing activities. Firms must collect specific identifying information from new customers and verify that information. This program is essential for maintaining the integrity of the financial system and preventing illegal activities. Understanding CIP's role is crucial for compliance professionals and anyone opening customer accounts. Question 22. Which of the following statements about municipal bonds is true? A. The interest earned on all municipal bonds is exempt from federal income tax. B. Municipal bonds are typically issued by corporations to fund public projects. C. The interest earned on municipal bonds may be exempt from federal, state, and local taxes for residents of the issuing state. D. Municipal bonds are guaranteed by the U.S. government. Answer, C. The interest earned on municipal bonds may be exempt from federal, state, and local taxes for residents of the issuing state. A key feature of municipal bonds is that the interest earned is generally exempt from federal income tax. Additionally, for residents of the state where the bond is issued, the interest may also be exempt from state and local income taxes, providing a triple tax-exempt benefit. Municipal bonds are issued by state and local governments, not corporations, to finance public projects. They are not guaranteed by the U.S. government. Understanding their tax-exempt status is fundamental for investors, especially those in higher tax brackets, seeking tax-efficient income. Question 23. Which entity is primarily responsible for creating rules for municipal securities brokers and dealers, but does not enforce those rules? A. SEC. B. FINRA. C. MSRB. D. Federal Reserve Board. Answer: C. MSRB. The Municipal Securities Rulemaking Board, MSRB, is responsible for creating rules for municipal securities brokers and dealers, as well as municipal advisors. However, the MSRB does not have enforcement power over its own rules. Enforcement of MSRB rules for broker-dealers is carried out by FINRA and the SEC, while the SEC also enforces MSRB rules for municipal advisors. Understanding the MSRB's unique rulemaking but non-enforcement role is critical for navigating the regulatory landscape of the municipal bond market. Question 24. What is the primary function of a transfer agent? A. To execute trades on behalf of customers. B. To maintain records of stock and bond owners and handle dividend and interest payments. C. To underwrite new securities offerings. D. To provide investment advice to institutional clients. Answer: B. To maintain records of stock and bond owners and handle dividend and interest payments. A transfer agent is responsible for maintaining accurate records of a company's stock and bond owners, including changes in ownership. They also issue new certificates, cancel old ones, and handle the disbursement of dividends and interest payments. This critical back-office function ensures that investors' ownership is properly recorded and that they receive their entitlements. The transfer agent's role is distinct from that of a broker-dealer, executing trades, or an underwriter, new offerings. Understanding their function clarifies a key operational aspect of securities ownership. Question 25. An investor who sells a call option is said to be taking which position? A. Long. B. Short. C. Naked. D. Covered. Answer: B. Short. Selling an option, whether a call or a put, means taking a short position in that option. When an investor sells a call option, they are obligated to sell the underlying stock at the strike price if the option is exercised by the buyer. This position profits if the underlying stock price falls or remains below the strike price. Understanding the terms long and short is fundamental to options trading, as they define the investor's rights and obligations. The terms naked or covered refer to whether the seller owns the underlying asset, not the basic position type. Question 26. Under what circumstance would a broker-dealer be required to file a suspicious activity report, SAR? A. When a customer makes a large cash deposit, but it is clearly from a legitimate source. B. When a transaction or series of transactions raises suspicion of money laundering or other illegal activity. C. When a customer opens a new account without a social security number. D. When a registered representative changes their address. Answer: B. When a transaction or series of transactions raises suspicion of money laundering or other illegal activity. Broker-dealers are required by law to file a Suspicious Activity Report, SAR, with FinCEN, Financial Crimes Enforcement Network, when they detect suspicious transactions that meet certain criteria and suggest potential money laundering, terrorist financing, or other illegal activities. This obligation is a crucial part of anti-money laundering (AML) regulations. SARs are confidential and are not disclosed to the customer involved. This reporting mechanism is vital for law enforcement agencies to track and investigate financial crimes. Understanding the SAR filing requirement is a core compliance responsibility for broker-dealers. Question 27. Which of the following best describes the characteristics of a money market mutual fund? A. Invests primarily in long-term corporate bonds and equities. B. Seeks to maintain a stable net asset value, NAV, of $1.00 per share. C. Is typically used for aggressive growth strategies. D. Provides investors with tax-exempt income from municipal bonds. Answer: B. Seeks to maintain a stable net asset value, NAV, of $1.00 per share. Money market mutual funds aim to provide investors with a stable net asset value, NAV, of $1.00 per share, offering liquidity and capital preservation. They achieve this by investing in short-term, highly liquid debt instruments such as treasury bills, commercial paper, and certificates of deposit. These funds are generally considered low risk and are often used as a cash management tool rather than for aggressive growth. While some may invest in municipal debt, their primary characteristic is the stable NAV and short-term holdings, not tax-exempt income for all funds. Understanding their objective is key to proper asset allocation. Question 28. What is the primary role of the Depository Trust and Clearing Corporation, DTC? A. To set interest rates for margin accounts. B. To provide investment banking services for new issues. C. To facilitate the efficient clearing and settlement of securities transactions. D. To supervise the conduct of registered representatives. Answer: C. To facilitate the efficient clearing and settlement of securities transactions. The Depository Trust and Clearing Corporation, DTC, is a critical piece of the financial market infrastructure, providing post-trade clearance, settlement, and information services. Its primary role is to facilitate the efficient and safe clearing and settlement of virtually all U.S. securities transactions, reducing risk and improving operational efficiency. By centralizing the clearing and settlement process, the DTCC helps ensure the timely and accurate transfer of securities and funds between parties. Understanding the DTCC's function is important for comprehending the mechanics of how trades are finalized in the financial markets. Question 29. An investor's portfolio consists of 60% equities and 40% fixed income. If the market value of equities increases significantly, causing the portfolio to become 70% equities and 30% fixed income, what action would be considered rebalancing? A. Selling more fixed income and buying more equities. B. Selling equities and buying fixed income to return to the original allocation. C. Holding the current allocation and doing nothing. D. Increasing the overall leverage in the portfolio. Answer: B. Selling equities and buying fixed income to return to the original allocation. Rebalancing is the process of adjusting a portfolio's asset allocation back to its target weights after market movements have caused it to drift. In this scenario, the portfolio became overweight in equities due to market appreciation. To rebalance, the investor would sell some equities and use the proceeds to buy fixed income, thereby returning to the desired 60-40 allocation. This strategy helps manage risk, maintain the intended risk/return profile, and can involve selling high-performing assets to buy lower-performing ones. Understanding rebalancing is essential for long-term portfolio management. Question 30. Which type of offering allows an existing shareholder to sell their shares to the public? A. Primary offering. B. Secondary offering. C. Initial public offering, IPO. D. Follow-on offering. Answer, B. Secondary offering. A secondary offering involves existing shareholders, such as company insiders or institutional investors, selling their previously issued shares to the public. The proceeds from a secondary offering go to the selling shareholders, not to the issuing company. This differs from a primary offering, which includes IPOs and follow-on offerings by the company, where the company sells new shares and receives the proceeds. Understanding this distinction is crucial as it impacts where the capital raised is directed. An IPO is specifically the first time a company offers its shares to the public. Question 31. An investor is primarily concerned with generating a steady stream of current income rather than maximizing long-term capital growth. Which investment goal best describes this focus? A. Capital appreciation. B. Growth. C. Income. D. Speculation. Answer, C. Income. Income investing is a strategy focused on generating regular cash flow from investments, typically through dividends from stocks or interest from bonds. Investors prioritizing current income, such as retirees, often favor this approach. In contrast, capital appreciation and growth investing target increases in the value of the investment, while speculation involves higher risk for potentially larger returns. Understanding different investment goals is key to aligning investments with client objectives. Question 32. Which of the following underwriting arrangements minimizes the financial risk for the issuer, as the underwriter acts only as an agent without guaranteeing the sale of all securities? A. Firm commitment underwriting. B. Best efforts underwriting. C. Standby underwriting. D. All or none underwriting. Answer, B. Best efforts underwriting. In a best efforts underwriting, the investment bank acts as an agent for the issuer, agreeing only to sell as many shares as possible without guaranteeing the sale of the entire issue. This minimizes the financial risk for the issuer, as any unsold shares remain with the issuer. In contrast, a firm commitment underwriting obligates the underwriter to purchase the entire issue, thereby assuming the risk of unsold shares. Question 33. Which of the following entities issues Ginnie Mae, GNMA, pass-through certificates? A. Federal National Mortgage Association, Fannie MA. B. Federal Home Loan Mortgage Corporation, Freddie Mac. C. Government National Mortgage Association, Ginnie Mae. D. Private Commercial Banks. Answer, C. Government National Mortgage Association, Ginnie Mae. Ginnie Mae, Government National Mortgage Association, is a U.S. government corporation that guarantees investors the timely payment of principal and interest on mortgage-backed securities, MBS, backed by federally insured or guaranteed loans, such as FHA and VA loans. It is Ginnie Mae itself that issues the pass-through certificates, which represent an undivided interest in a pool of mortgages. Unlike Fannie Mae and Freddie Mac, Ginnie Mae does not buy or sell loans or issue MBS directly, rather, it guarantees those issued by approved private lenders. This explicit government backing makes Ginnie Mae securities particularly attractive to risk-averse investors. Question 34. Which of the following is not typically a responsibility of a registered representative when opening a new customer account? A. Obtaining the customer's social security number or tax identification number. B. Explaining the risks and rewards of recommended investments. C. Verifying the customer's identity through documentary evidence. D. Acting as custodian for the customer's physical stock certificates. Answer, D. Acting as custodian for the customer's physical stock certificates. While a registered representative is responsible for collecting crucial customer information for identity verification and suitability assessments, and for explaining investment risks, they do not typically act as custodians for physical stock certificates. Custodial services, which involve holding and safeguarding client assets, are performed by the broker-dealer firm's operations department, often through a clearing firm or a designated custodian. This separation of duties helps protect client assets and ensures proper record-keeping. Understanding these distinct roles is important for comprehending the operational framework of a broker-dealer. Question 35. An investor receives a dividend from a stock. For tax purposes, how is this typically treated? A. Always tax-exempt. B. Always subject to capital gains tax. C. Taxed as ordinary income or at a lower qualified dividend tax rate, depending on holding period and type. D. Only taxed if reinvested in the same company. Answer: C. Taxed as ordinary income or at a lower qualified dividend tax rate, depending on holding period and type. Dividends received from stocks are generally taxable. Qualified dividends, which meet specific holding period requirements, are taxed at preferential long-term capital gains rates. Non-qualified, ordinary, dividends are taxed at an investor's ordinary income tax rate. Dividends are taxable in the year they are received, regardless of whether they are reinvested or taken as cash. Understanding the tax treatment of dividends is crucial for investors to accurately calculate their after-tax returns and plan their investment strategies effectively.